Hi, thank you for joining us today. My name is Anthony Cosentino. I'm a financial advisor here with Wilde Wealth Management Group. Today we're joined by Gene Goldman, Chief Investment Officer of Cetera Group, here to talk about the crazy times we're in right now. So I know you are all wondering what's going on and what to expect as we move into the second half of the year here. And with everything going on, we felt it timely to invite Gene here to talk about what we're expecting and what we hope to expect to see the second half of the year. So Gene's been in the industry for 28 years and very knowledgeable on the topic, and he's here to be able to enlighten us. So from here, I'll hand it over to Gene, and he'll take it from here.
Hey, good day, everyone. Welcome to my presentation, Market Outlook for three themes for 2022. I'm Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. Again, welcome to my presentation. What we're going to do today is talk about a few things. And really the key three things are: number one, why markets are volatile; number two, updates on our three investment themes. I know we've discussed these with you before, but we're going to kind of talk about, given the market volatility, how these are playing out, these themes are playing out. And number three, the markets are down. They're down a good chunk. And let's talk about why we are cautiously optimistic on these levels, why we see somewhat of a limited downside from these levels. So if you look at this next slide, to really set the stage, market volatility has been huge this year. If you look at this slide plots the S&P 500, and that's a broad market benchmark. And it represents sort of like a summary of all the US companies, 500 companies in a benchmark that represents the US economy. And what you see here is that the stocks on the right-hand side, this index is down about 19% this year. It's a pretty big decline, and I'll talk about what that means. But this index, the S&P 500, is in what's called a correction. And a correction is when stocks fall more than 10%, but not 20%. And 20% is a very important number. 20% in sort of the investment perspective is it's what's called a bear market. So a decline of more than 20% from its highs is a traditional bear market. And, stocks are teetering between correction and bear market. And by the time you see this, we will know where we are exactly. But we do have some optimism, but let me take a step back and we talk about what's causing this volatility. So, as I said, stocks are down about 19% this year, not a great year so far. What's causing this volatility has really been market uncertainty about the Fed. The Federal Reserve, is removing stimulus to address the inflation problem. And we'll talk about this in a little bit. But basically the Federal Reserve, they're in charge of two key tenets, what they do, two key perspectives. Number one, they want to maximize employment. They want to make sure we all have jobs. Number two is that they want to minimize sort of these big sharp fluctuations in inflation. They want to keep prices stable. They've done the first really well. We all have jobs. We have, we'll talk about this in a little bit later, but we've got about 5 million more jobs than people looking for jobs. There's plenty of jobs out there. The second perspective about keeping inflation in check, they haven't done a great job. And we talked about this with you last year, that inflation was not as transitory as the Fed claimed. And now this is starting to bite them, really quickly. So you have this uncertainty about how the Fed will raise rates, because when they raise rates, this theoretically slows the economy down. This should theoretically reduce inflation pressures. And there's concerns that maybe the Fed will raise rates too much, and all of a sudden we have a recession. And we'll talk about these, and these are really our themes. Also driving market volatility has been these COVID concerns in China, impacting supply chains. So a lot of companies have come out and said, hey, we can't get our supplies to build things because of shutdowns, lockdowns in China. This is impacting overall supply chains. And another reason is that there's been a sell-off in cryptocurrencies. We're not recommending cryptocurrencies. We're not saying we like them or don't like them. All we're saying is that these are sort of these higher risk assets, that there's concerns that the weakness, the drop in these values will spread to other risk assets. So you take all this together, what do you have? You have this significant market volatility. So with this as a backdrop, our three themes for 2022 continue to be these, and I'll talk about these more in depth. Number one, the Fed will be aggressive, but not as aggressive as the market currently expects. And this is important. Talk about this a lot. Number two is the good news. The economy can withstand less monetary stimulus. People out there, there's a lot of people in my shoes, a lot of people that you're listening to on TV saying, we're in a recession, we're going down. We don't see it. The economy is still pretty strong. We may have a recession, a year from now, 2 years from now, but right now we just don't see a recession. The economy is still too strong. The third theme is that market volatility is going to be jumping for a long time. These big swings in the market, these ups and downs, unfortunately, are going to be with us for a very, very long time. So the first theme, again, the Fed needs to be aggressive and they need to raise rates dramatically, but not as dramatic as the markets expect. If you look at this slide shows food, okay? And we all know, with the Russian invasion of Ukraine, and if you take a step back, it's a terrible humanitarian crisis. You look at, unfortunately, human loss, and our hearts are with those who have loved ones or who have people in Ukraine. It's a very, very awful perspective. But if you kind of take a step back and you look at it from a market and economic perspective, what we're seeing is that there's been a huge surge in food prices. You look at this slide and you look at corn, wheat, and soybean prices. These have all surged dramatically. Ukraine is considered the food basket of Europe, or the bread basket of Europe. If you take Ukraine plus Russia, you get about 30% of global wheat exports. And then with the war taking place within the Black Sea, it's causing a lot of supply chain disruption around food. Plus fertilizer prices are surging. So the issue here is that food prices have dramatically moved higher, and you see this here. The other commodity that's moved higher is oil, and you see this in gas pumps already. I read some stat that we continue to hit record highs on our national average gas price. It's a terrible time right now. Oil is moved higher because basically investors are expecting that we'll have sanctions on Russian oil, that the disruption of oil supply will put upward pressure on oil. Also, coming into the war, the Russian invasion of Ukraine, we also had a supply-demand imbalance within oil in general. As I mentioned to you before, right now in the US, we produce about 1.5 million less barrels per day than we did pre-pandemic, because companies are not feeling incented to drill more wells. There's concerns out of Washington about clean energy and all those ramifications. So a lot of these big oil companies are saying, you know what? Why should we spend money to drill these wells if we aren't sure about what's going to take place in Washington? So you take all this stuff, you take higher food prices, you take higher energy prices, and this really creates an inflation problem. So a couple of weeks ago, we did get a report. It's called CPI, and CPI is it's an inflation measure. It's called the Consumer Price Index. And if you look at the chart, and you can see the chart here, this shows year-over-year CPI. And what's very clear is that surge on the right-hand side. The Fed made a mistake last year. Now they need to play catch-up to address this inflation mistake. So the Fed has an inflation problem, and again, it's not transitory. So CPI has moved significantly higher. But the good news, and I'll talk more about the good news a little bit later, but the good news is that we feel with inflation, we are past the peak. For example, goods prices, prices of TVs and cars and appliances and apparel have actually started to come down. You may not see it yet, but they've actually started to come down. So again, inflation is an important perspective the Fed needs to address this, because again, they have two mandates: maximize, make sure we all have jobs, and number two is really keep prices in check, and they're not doing a good job on the second perspective. So again, inflation is a problem. To address this, on the next slide, the Fed has to basically remove monetary stimulus. So what this means is basically, the Fed has a bunch of tools at their fingertips that they can use to slow the economy down, really related around monetary. The easiest thing for them to do is to raise interest rates. How does this work? If the Fed raises short-term rates called the Fed funds rate, these rates move higher, then theoretically borrowing costs at banks go higher, mortgage rates go higher, home equity loans go higher. So if these are more expensive, let's say a home equity loan is more expensive, you're not likely to take it out. Therefore, you aren't going to borrow that money. Therefore, you're not going to use that money to buy more goods and services. And therefore, this puts less inflation pressure on the economy. I know I made a few assumptions, but that's sort of what the Fed is trying to do right now. If you look at the Fed funds rate, and this is their primary tool, right now it trades between 0.75% to 1%. And don't worry about the trading between it. Just basically, you can just say that the Fed funds rate is trading between 0.75% of 1% and 1%. It's basically this range that the Fed is targeting. If you look at this slide, and this slide has a bunch of stuff on here, all this slide says is that the markets expect that Fed funds rate to be about 2.75% to 3% by year end, or even more. And if you think about sort of the number of Fed meetings that they have between now and the end of the year, there's 5 meetings, and we'll make the assumption that there won't be any surprise rate hikes, that the market is expecting the Fed to raise rates 0.5%, 3 meetings, and then 1/4, 2 meetings. Again, this may shift around, but that's what the markets are expecting. It's really our opinion, and this really ties into our first theme, is that the Fed will be aggressive. Yes, they need to slow this inflation down, but the markets are being too aggressive in terms of how much the Fed will raise rates. And there's good news behind this, because if the Fed does not raise rates as much, borrowing costs don't go as much, it does not impact the economy as much. We do think the Fed will not be as aggressive as the markets are anticipating. And there's really 2 primary reasons, and there's a couple other reasons, but there's 2 primary reasons why. Number one, inflation is starting to slow down. That's important. You know, I know I showed you that chart earlier, and you're like, Gene, inflation is not slowing down. It's like up 8.3% year over year. Yes, it is still very high. But if you look at the prior month, it's at 8.5 year over year. So it's coming down a little bit. But more importantly, though, if you peel back the cover and you look at the components within inflation, inflation is starting to slow down. You know, we did see, for example, we did see services inflation rise. So airfares, people are going and flying everywhere and jumping on planes. And so that we saw a surge there. But like rent, for example, rent inflation is starting to roll over a little. That's good news. And if you look at goods inflation, and I apologize for that loud noise, there's a plane flying right above me. But if you look at goods inflation, so prices for cars and TVs and appliances, you're actually seeing goods inflation is starting to slow down. Goods inflation slowing down is so important. Goods inflation represents about 60% of the gain in CPI in the last 2.5 years. So what happened is that you know, during the working from home, during the, you know, not spending money at bars and restaurants, all of us we were just buying stuff on Amazon. We're buying 5, 10, 15 Peloton bikes. We're buying TVs and cars, and goods prices actually surged because there's very few goods and everyone's trying to buy the same goods, very low inventory. And this is kind of contrary to, say, maybe 5 or 6 years ago. Think about, let's say maybe 2017. If you went to, say, Best Buy or Comp USA or, you know, another store, you would see a TV you like, and you would look at it and say, oh, I like this TV. I'm really interested in buying it. But in the back of your mind, you would know, okay, if I come back 6 months from now, that TV is probably gonna be cheaper, because we were in a very goods deflationary environment. Prices were coming down, cheaper products, cheaper commodities, easier to build, and we were in a goods deflationary environment. But because of the pandemic, because of what took place, because of all the money that people wanted to spend staying at home, goods inflation actually reversed, and we saw prices move higher dramatically. I know I kind of went on to this big tangent, but it's important because goods inflation is what's really pushed CPI inflation higher in the last two plus years. In the most recent CPI report, we saw, as I mentioned before, apparel has come down. We saw appliances are starting to decline in price. That's good news. Prices are starting to roll over. So the good news is that inflation, in our opinion, is starting to slow down, and that's good for Fed not to raise rates. What I think will also help inflation is something called base effects. And this slide shows an example of base effects. So base effects, the economics mumbo jumbo is basically you have a higher base the prior year, so it's harder to beat that year over year. Let me give you an example. So if you look at used cars, okay, used cars last year, let's say the last 12 months, we're up about 41% year over year. That's a big jump. And we know why, because it was hard to find new cars because of supply chain issues, because of other issues. So everyone just bought used cars. Used cars surged 41% year over year. For used car prices year over year to be flat on a go-forward basis, they have to surge another 41%. So that's the power of base effects. And in our opinion, they're not going to surge 41%, because you look at this slide. This is the used car vehicle index. Inventories are increasing dramatically. I think inventories are up 5% in the last 12 months for used cars. There's more used cars, and you see the slide here, prices are falling for used cars. So this will all start to play into inflation. And if inflation starts to roll over and come down faster than the market expects, the Fed, in our opinion, may not raise rates as much as the market expects. Again, they're going to be aggressive, but not raise rates as much as the markets expect. Other inflation things that we're starting to see roll over, I mentioned this earlier, rent inflation is starting to roll over. Rent inflation was the biggest concern for the Fed. Remember last year, they said inflation is short-term in nature, it's going to go away. All of a sudden, in November of last year, they changed their tune pretty quickly because all of a sudden they saw rent surging. And rent is a very sticky inflation. I know we talked about this before, but if rent is very sticky and it does not go down that much. Let's say that if your landlord raises your rent, they're going to knock on your door and say, hey, I just saw CPI is coming down lower, I'm going to cut your rent. That does not happen. So rent inflation is such a sticky inflation. But the good news, if you look at this slide, it's starting to roll over slowly, but it's starting to roll over. Also, the Fed has a preferred inflation measure. It's called the PCE. They like to look at the inflation within the PCE. And if you look at the key components that go into PCE, these are all starting to roll over. I want to show you one example here. This shows transportation and warehousing costs. It's a very important component in terms of manufacturing, in terms of delivery and supplies. These are high and still very high, but it's rolling over very quickly. So again, I know oil is high, gas is high, I know food is high, but other parts of inflation are starting to roll over pretty quickly and pretty fast. And again, that's one of the reasons why we do think the Fed may end up raising rates less than the market expects. The second reason is what's called supply chain issues. And if you think about, supply chains were really tight in the last couple of years because we all demanded, we want so much stuff and goods. And, companies could not replenish inventory fast. I mean, you can use the classic example of toilet paper. It's hard to find toilet paper during the pandemic, of course. Or you can look at like bikes, or you can look at Peloton bikes, or you look at TVs. And it was really difficult. But what we're seeing now, the ramifications of a tight supply chain is that basically everyone's demanding the same goods, there's very little inventory, and this puts upward pressure on price. So what we're seeing now, again, another reason why we think the Fed may be less aggressive, the supply chains are improving very, very fast. This slide shows the port of LA, and the port of LA, and it shows the number of ships going through. And basically the number of ships going through the port of LA is starting to decline pretty fast and pretty quickly. Good news is that as fewer ships go through the port of LA, this allows more to be unloaded. This helps to reduce some of the supply chain burdens. Good news there. Again, supply chains are starting to improve very, very quickly. So if you think about our first theme, our theme is the Fed will be aggressive, but not as aggressive as the markets anticipate. And again, the reasons are inflation is starting to slow down. You don't see it yet, but it is starting to slow down underneath it. Number two, supply chains are going to improve. Other reasons, the dollar, a stronger dollar. Our US dollar is up about 6% in the last year plus. And in the past, when the dollar has rallied significantly, this has acted like a rate hike because the Fed says, okay, the dollar is higher. It's hard for our exports to compete with in other nations. So therefore, it's almost like a rate hike. And the fourth reason is that this market volatility sort of can make the Fed say, you know what, if we raise rates too fast, too quickly, it creates market volatility, market uncertainty, and we need to slow down. So all we're saying is that the Fed will be aggressive, but not as aggressive as the markets predict. So our second theme, I think this is probably the one that just will resonate with all of us a little bit more. And this is more the good news, is that we do believe that the economy can withstand less monetary stimulus. The economy can withstand less of the Fed raising interest rates. And it's very, very important. If you look at go on TV, if you read papers and everything, everyone's talking about, hey, we are in a recession right now. And we always joke there's like a bull market in the recession predictions. We just don't see it. I mean, we believe the economy can withstand this less stimulus. Last quarter, for example, US economic GDP, so GDP, our gross domestic product, fell 1.3%. And everyone's like, oh my God, it's bad, it's bad. That was actually a great number because if you pulled back the cover, what you saw was that we had a surge in consumer spending. You and I were buying a lot. A surge in business spending. Businesses were spending a ton of money. And I'll show you a slide on this in a second. The third thing, and the biggest and most important thing, was a surge in imports. And based on, economics 101 and all this mumbo jumbo, a surge in imports is bad because basically we aren't selling as much exports. So just think about that. Imports are surging dramatically. That's a clear sign that supply chains are improving dramatically because we're importing a lot more than we did before. So keep that in mind. while this is said, while we are optimistic that the economy can withstand less stimulus and our base case is not a recession this year, we do understand there are ramifications. You look at this slide here. The slide's an important slide. The slide shows an example of the impact of higher rates can have on you and I. So what this slide shows, it plots the monthly mortgage payment based on the median home price in the United States. And what it shows is that if you went in and bought the median home price or median price home in the United States on January 1st, and let's say you didn't buy it, and then you went back to the same home on March 31st to buy it, and you got a mortgage, your mortgage payment in just 3 months will have increased by 28%. It's a big jump, and that is going to impact the economy. And we do recognize the fact. So again, mortgages, higher rates are really impacting mortgage prices, mortgage prices, they're going to really impact mortgage prices, and they're really going to impact sort of economic growth. So again, we do understand the ramification of that. It's very, very important. So as I go to this next slide, let me recap. So our second theme is that the economy can withstand less monetary stimulus. Yes, there are ramifications. You look at higher mortgage rates, higher car borrowing, it's going to impact demand. But again, there's some key reasons why we don't see this impacting economic growth. We don't see it putting us into a deep recession. Let me rephrase that. Number one, inventory to sales ratios. So as the supply chains are improving, as we start to slow down in terms of consumer demand because higher rates are going to impact what we spend, this will allow companies to rebuild inventory. So you look at this slide plots a very simple ratio, inventory divided by sales. And when sales occur at a faster rate than inventory, the line moves down dramatically. And you can see we are at very low inventory levels right now. The good news is that we're starting to see some inventory rebuild. This will be good for the economy and good for manufacturing. You look at this next slide. This next slide is another reason. And I think probably the most important reason about our economy is that right now, our labor market is so very, very strong. I said this at the onset. We have 5 million more jobs out there than people looking for jobs. I mean, there are so many jobs. And yes, the labor market is going to slow down. Yes, our current unemployment rate of 3.6%. Yes, our jobless claims at a 50-year low will increase. But we don't see them increasing dramatically higher because the labor market is still very, very, very strong. And you're seeing labor force participation increase. Again, this is very positive foundationally for the economy. Another reason, I touched on this earlier, is business spending. So if you think about a very tight labor market, it's hard to find people to work. There's 5 million more jobs than people. So there's a really difficult time to find workers. So what companies are doing is that they're going out and they're spending a ton of money on machines, on tools, on equipment to really maximize productivity, to really say, you know what, we can have the same number of people, but we can produce a lot more with these big, ginormous machines. And you see this slide here. There's been a huge surge in spending on, this non-defense capital equipment, a great positive foundation for our economy. So with all that said, there's an index out there called the Leading Economic Index. It's called the LEI. It's 10 different indicators around, manufacturing, around jobs, around, manufacturing hours worked, around jobless claims. Again, it's a great indicator. And what you see on this chart, it moves up and down over the course of time, but it has a very high predictability in terms of predicting a recession. Every time it's gone negative, we've had a recession within 12 months. If you look at this slide here, yes, on the right-hand side, the data has started to roll over. It's not been that great, it's rolled over. But what you see importantly is that we are nowhere near any type of recession warning indicator. It is lower, but it's not flashing any type of nasty recession. So overall, we do believe that for the consumer is in great shape with this very strong labor market. Also, we have high savings rates. Also, we have a low debt to income levels. And with the consumer being 70% of the economy, that's great news. We are in great shape. Business spending is okay, and the LEI is pretty strong at these levels right now. So that's our second theme. Again, the first theme is that the Fed will be aggressive, but not raise rates as much as the market expects. Number two, the economy will be able to withstand less monetary stimulus, and a recession is not our base case. The third theme is that this market volatility, these big swings in the market right now, looking at the market, down significantly, these big swings in the market will continue for some time, these big ups and downs. And it makes sense. There's many reasons why. There's concerns about the Fed policy. Is the Fed late to the game? Will the Fed raise rates too much? There's also an overall impact, on the economy. Will this cause us to go into recession? We believe that volatility is going to continue to be elevated for some time as markets and participants kind of grapple with both sides of the news, the good news and the bad news. But most importantly, we feel the downside is limited in these levels. I guess you would say we're cautiously optimistic. So if you look at the slide, there's two main reasons why we're optimistic at these levels. Number one, valuations. So if you think about the stock market, we as market strategists, we like to look at the stock market and say, is it expensive or is it cheap? And one really common measure is something called the PE ratio, price to earnings ratio. So what that is the price of the S&P 500 or the index divided by the earnings within the index, price earnings ratio. The lower it is, the cheaper valuations are. The higher it is, the more expensive valuations are. If you look at this slide, the purple line represents the PE ratio on forward earnings for the S&P 500. And right now it's about 16.5. Just a few months ago, it was around 22. At 22, it's near its high. It's pricing in absolute perfection. Today, around 16.5, you have a cheaper stock market. You have much more attractive valuations. Yes, valuations can pull back. Yes, stocks can go down even more. But the good news is that blue line that goes higher and higher and higher, those are forward earnings. So throughout this market uncertainty, throughout this market volatility, analysts are still raising earnings estimates. They're still saying companies are able to make money in this environment. Unfortunately, a lot of them are raising prices on us. We're paying more, but you're seeing the fact that customers like you and I are able to bear these additional costs as of now. So all I'm saying, good news is that valuations are much more attractive, pricing in less absolute perfection. The other reason that we kind of believe that there's less potential downsides of this kind of cautious optimism is that the credit markets are okay. So the credit markets, the bond markets, it's a very important indicator. If you look at this slide, it's an important indicator because it's how companies borrow money behind the scenes. And if these dry up, if these get really bad, it really impacts the economy dramatically. What I show you here it's called the high yield spread. And what this is, it's the spread, the additional compensation that an investor requires to invest in a high yield or a riskier bond relative to a, say, safe US government bond. It's that spread and the difference. When the spread moves higher, that means investors are saying, whoa, I'm really worried about the economy. I'm really worried about the market. And because of that, I want more compensation. I want more compensation for buying your bond. And what you see here, like if you see a big surge on the left-hand side, that was back in 2008. That was the Great Recession. Valuations spread surged dramatically. Or during early 2016, you see it surge again dramatically because concerns of a recession. The good news here is that despite the fact that the S&P 500 stock market is down 19%, through the beginning of the year, the good news is that spreads have not widened that dramatically. Spreads have not widened too much. If you see on this slide here, they've gone basically from about 350 basis points to about 480 basis points. Very, very small. Very, very, very small. So that gives us confidence that the credit markets are not flashing any bad news. So our three themes, number one, the Fed will be aggressive, but less aggressive than the markets expect. Number two is that the economy can withstand less stimulus. And three, market volatility is here for a long time, but we are cautiously optimistic that the downside is pretty close. With all that said, stocks are down 19%, and we have had a tough time. What I think is most importantly is this slide here. This slide shows that for the S&P 500, that the S&P 500 in the last 42 years has been positive in 35 out of 42 years. That's great news. We're in an upwardly biased market. But through those 42 years of the markets going up and down, the average intra-year loss, the average downside, the average move down, the average pullback, the average correction is down 14%. So what this means is that this volatility that we're seeing, these allocations back and forth are really a normal part of investing. Stocks down 14% is a normal part of investing. Again, I know it's hard. I know it looks difficult. I know it's scary sometimes given these big market swings, but this is a normal part of investing. Our opinion, we don't see a prolonged bear market, like a nasty, nasty bear market, because you need a pullback, which we have a pullback now, but you also need a recession. We don't see a recession within the next 12 months. That's not our base case. So again, I know I kind of went all over the place, but it's important for you to realize that this volatility, these swings in the market are a normal part of investing. So with that said, I just really want to thank you. I know, again, we went all over the place, and I do apologize for the technology snafu with my dog and the airplane going by. I really, really apologize. But again, this is us working from home, being efficient and being able to communicate to you. Thank you so much for taking the time to listen today. Obviously, if you have any questions, please reach out. Definitely, keep in mind, it's a very interesting time. As I told you last time, diversification is a key strategy. Having exposure to different parts of the market is very key in this environment. And number two is making sure you and your portfolios are aligned with your investment objectives. And how do you do this? Stay in touch with the team, reach out to them, let them know any potential changes in terms of your lifestyle changes, your liquidity needs, or anything, because they need to make sure that your portfolios are aligned with your risk objectives. They don't want you to be too aggressive or too conservative. You need to be aligned to where you are right now. So thank you so much. Really appreciate that, and have a great day.
Well, thanks, Gene. That was really informative. I really appreciate it. I know, like we said, markets are crazy these days and times are tough. And, it's great to hear that perspective from you as to, where we've come from and where we see the markets headed the rest of the year. So from here, if you've got any questions or concerns, please don't hesitate to reach out. Reach out to your dedicated advisor with the firm, or if you don't have one yet and you're listening to this as a new prospective client, feel free to reach out to us, and we're happy to help. But really, we want to make sure that we're here for you during these times, and that way, don't hesitate. If you've got those questions, make sure that you are reaching out. That way we can help, calm any sort of concern that you may have. But once again, thanks for tuning in, and have a great rest of your day. Bye-bye.